Warsh, you can see the entire live stream here, all the main points that I talked about, and then also the slide deck for yesterday. You can download this, and click on it, and it will bring up the entire slide deck from yesterday, and you can go through that on your own. And if you're trying to understand this idea of the distribution more, that's exactly what you want to do. All right. James, welcome.
Good morning. Good morning.
How are you doing?
Ground running here. Well, I'm busy watching the markets out there, trying to get another video up for the people, and I am watching the chaos in the Avis market, which I'm sure is right about what you're talking about right now. So,
wait, did you say the Avis market?
Oh yeah,
dude, we were just going over that.
Oh, there you go.
We were talking about how the distribution is changing for that.
Yeah, I feel like that's probably what you spent the last hour on.
So one of the things that I was talking about is this. We're trying to go over intuitively this idea right here on trimming the tails and understanding what that means for Warsh, and then also connecting that to knowing the market regime that we're in and how other people are interpreting it. So what I think is taking place is we have distribution of outcomes, which is, well, okay, are we in a left tail or a right tail period of time? And then are we in a, normal period of time where there's signal or noise, or how do we interpret where we are on the distribution of outcomes? And I think one of the key things in markets, and you could actually probably speak to this with poker, is how your opponent views the distribution that we're in. Because if Kevin Warsh views the distribution of changes, or if he views a left tail or right tail change as noise versus signal, or if he views us as in a normal period of time versus a volatile period of time, that's going to directly influence his actions. So how other people, whether it's Warsh or it's hedge funds or it's institutions or whatever that might be, how they view the distribution of outcomes is one of the major things that you need to understand as you're taking risk in markets, because that's going to determine their actions and how that kind of plays out with buying and selling pressure across assets.
Yeah. So when you say it like that, it makes me think. Can you go back to the trimming slide?
Yeah.
It makes me think of, in poker, for instance, it's all poker is. Most people, actually, it's funny how it translates so well to markets, right? Because most people think markets are like up or down, left or right. It's very easy, right? Like, but in reality, poker is a game of ranges and determining somebody's range. And then if you could do that better than your opponent, you should therefore be able to exploit that, right? So it's literally just a counter exploitation game when it comes down to it. So if Warsh is a poker player playing against us at the table, my goal is to figure out what type of range, how does he approach looking and breaking down a hand range? And if I could get any glimpse into that through information, through hands we play together or he plays against other people, I could start to determine like, oh, he is very focused on this. If he is focused on this doesn't matter. This matters more. How should I then exploit that to take more chips from him in the long run, right? And then I have to basically have feedback on whether or not I'm right, right? Which is going to be just through repetition over time. And then I'm going to have to kind of adjust and hope that he's not noticing us adjust, so that if he's a good player, he should therefore adjust. All while he's trying to figure out how I think about my range and trying to exploit that. So, the general public kind of views markets and interest rates and inflation a certain way. We also think of it a certain way. Warsh thinks of it a certain way. And then it's like trying to figure out the complexity and the movement through all of those ranges. So clearly, Warsh wants to look at ranges a different way than Powell did, right? And thinks it's a better way. And what's fascinating to me is that it's not straightforward. It's not easy. Like, you can't go ask anybody out there and say, hey, what regime are we in right now? And have just like a perfect answer, right? It's all just like poker, where everybody's got their own read and style and implementation. So yeah, that's how I guess I picture it. Does that make sense at all?
No, I think that's really key, because I think one of the tweets that I shared recently is, you just talked about what you need to do is understand the distribution of how each person in the room views the distribution. Because at the end of the day, we're trading against other people. There's someone on the other side of your trade. And people don't like to think about that. I think there is an element where it's you versus you, but there's also but to be able to play you versus you and have that meta level, understanding other people's distribution and interpretive framework is an input into you being the best version of yourself, right? And I think this connects to being able to develop an informational edge, and this connects to this idea of I shared this tweet recently on liquidity, and one of the things that I said was, if liquidity were contracting, there would be signs. These are not taking place right now. The short end plumbing of the system is only one input. So people are kind of bringing up, well, the reverse repo is doing X, Y, and Z. Okay. Well, how is that weighted into the changes in price action? And I think when you map, few people understand how to map long end rates, the risk curve, FX, and positioning as they net out, right? So I think this is a great, you could talk to this a little bit more. You have different people at the table that set the pace of the game sometimes, right? And you have different assets in markets that sometimes have a large impact and sometimes have a less of a strong impact, right? And that impact and that pace is always changing. And that's why I shared this model recently with paid subscribers that maps how I quantify, well, how is each asset mapping that pace of change it has or the impact it has, so that you kind of, I love thinking about it as like, you get in the boxing ring, you throw a couple of jabs and you're kind of like, oh, this guy's a lot stronger than I thought. He's actually moves way faster than I thought, or he can take a lot more punches or a lot less punches than I thought, right? And so you have this entire dynamic where there's all these changes taking place and their causal impact, which is why when you kind of have this idea of liquidity, in order to have correct iteration, you first need to have a falsifiable view with scenario analysis and redundancy planning. So it just means that I need to have a view set up that says, here's where I'd be right and here's where I'd be wrong. And that quantification, even if you're just doing it intuitively and intentionally, is what allows you to take massive bets. Because if you're not being precise in that and you're just kind of like shooting from the hip and being very loose, you can't take massive size, right? You can't size up your bets if you're not being precise in kind of that idea. Expand on that a little bit more, kind of from how you think about it in your experience in not only markets, but kind of poker.
I think when I hear that, I really like the pacing aspect. So guys, I don't know if you've all played poker, but a lot of guys at some point have. And professionals come in and they have an idea of how they play the game, right? And how like they in their heads see, oh, this is probably how I think the day is going to go. And when you sit down at a poker table, there is a quick learning curve, probably 5 or 10 minutes, see a few hands, talk to some people, and you quickly realize like what type of game you're in. And it could be a boring game, a dull, slow, tight game, meaning like hardly anybody's playing any hands. It's all older people. They're very protective of their money. Or it could be the complete opposite. Chaos. People are drinking, young people, guys with all sorts of money. Maybe they all want to be aggressive and the pots are flying, right? Those are two completely different scenarios. And then you have a choice to make, right? Like you know your game, hopefully, right? This is where I go back to like understanding yourself. And you have to think, all right, based on the table that I'm now at, the type of game, how do I best fit into that game? How do I best extract money from this situation? And some people might run into the mistake of they always want to be the table captain, right? I think I've talked about this with you, is like some guy will have an ego. He likes controlling the pace of the game. He wants to be the guy making the big bets. He wants everybody to look at him. The problem is you're going to run into other people that are the same.
Right.
And if you end up getting in an ego battle with another really good player, you're hurting yourself. You're getting into a position where you end up like playing one-on-one with the other best player at the table to theoretically establish some sort of dominance in the hierarchy, to therefore then take advantage of the worst players down the road because the other guy kind of caved. But in the meantime, you could just get bludgeoned. And if things don't go your way, or maybe the other guy is better than you and is a better table captain, you just lost the plot. You lost the complete plot. So my analogy here is that like Warsh just sat down at the table. And if you're doing a certain thing right now, the game dynamic is shifting. And if you think that you can now impose your will onto Kevin Warsh and the Fed, and you're going to be the table captain, I think you should reapproach that thought, right? Start to allow Warsh to drive the cadence of the game and then be like, okay, how do I now best fit in the Warsh game? Because it was the J-Pow game, right? It was the J-Pow game. Everything was going fine. Maybe you're up money or whatever, but J-Pow went home. Warsh sat down, and now the game is changing. So that's how I think about this.
Yeah, I agree. I think we've talked about this quote before from The Art of War, and it's if you know the enemy and know yourself, you need not fear the result of 100 battles. If you know yourself but not the enemy, for every victory you gain, you will also suffer a defeat. If you know neither the enemy nor yourself, you will succumb in every battle. I think it's just one of those things that just kind of really encapsulates that idea so well, because I think that you want to be able to know the constraints that other people operate under. So, for example, we have this entire idea that is kind of gone down in history with all of these guys, actually, with Besant and Druckenmiller and George Soros, where they, quote unquote, broke the back of the Bank of England, right? So that was a central bank. They were in the market. They were at the table. They were setting a cadence. But they came to a point where they hit this constraint. And there was a small moment in time where these other players could say, like, hey, this guy's really off balance. If we just push him a little, we can throw him out of the game. And that's when you had the entire, kind of currency collapse, and why they were able to bet on that. And they had, a massive year, and they had a one-way bet, right? There was that entire idea where, Druck and Soros and Besant, and they did that, right? And so I think that's a great example of how you want to think about that. But you have to remember that, I think people think about that trade and they're like, oh, wow, that sounds really cool. But that occurred like once right here in the distribution. The majority of the time, you're like over here, right? Or, right here. And so I think that's one of the things is like all of us go down in history thinking about like these extreme distributions, which are important to recognize when they come, because if you see that opportunity when it comes, all of your returns will come in those extreme situations, right? And so I think that's one of the things if you can recognize where you are in the distribution and when things change, that's when you can really size up your risk, know what's taking place, and then, capitalize on that, which kind of comes back to this entire idea about taking big bets, right? And obviously the Per and Oracle trade I've been talking about, but how have you kind of thought about taking big bets in your own experience and kind of through different market regimes and periods of time, and when you say, okay, this is a time to size up? How do you How have you thought about that and done that in the past, or what's been the evolution of that for you?
Yeah, I think this comes down to like what you're saying is like the best players are able to recognize when the opportunity set is like different, right? Like it's they're not just making it up in their story. They could recognize a situation or a hand in poker or a trade that comes out of nowhere that's like outside of the normal return of distribution, and then they can instantly flip a switch to get much more aggressive. So like my whole goal in trading, and I think this is kind of how you tend to operate too, is like let me try and map the regime that we're in, the normal distribution of expectations here. How can we position accordingly? And then every once in a while, there's going to be an outlier in the distribution that is an unintended consequence of the regime that we're in. So maybe Warsh is a guy who is trimming, right? He's focused on this narrow hand range, and you kind of can understand and construct your portfolio and your trades around that. But every once in a while, we'll just say Oracle or whatever, Oracle opportunity comes up and you realize, oh, Oracle going into some crazy outperformance is an unintended consequence of the hand range or the distribution that Warsh thinks about. And due to that, I don't think there's anybody positioned in the way I am. So it's worth taking a big bet on. It's like in poker, if a guy who's really tight, right, who's very scared of losing money, always thinks in a very specific set of situations that it is impossible for me to bluff, what should I do? Right? I should bluff every single time until he adjusts accordingly, right? And it's the same thing. Like if you find a great bet out there in the markets that basically what Warsh and crew and like the regime that we're in, it's like, well, they don't think this could ever happen, but it's kind of a free roll for you to do so until they adjust policy. Then you should take that bet very aggressively every single time, and nobody else will be doing it, right? Most people aren't going to pull the trigger on the bluff. They're just going to play the game in the regime that they're in and hope that like the poker gods bless them, right? So I think that's how I think about all of that.
Yeah, I think one of the key things that I'd love to build on there is we always go from vol compression to vol expansion. And whatever regime we're in right now is setting the stage for the next regime. And so you are creating the preconditions for the next vol expansion. And you want to spend time thinking about how that is going to have, like you said, unintended consequences. Because what I see is people trying to precisely quantify things that don't matter, right? They're always, going around. They have some new, they're always just going around with some level or some new technical analysis or some new thing that they're like, this precisely is going to tell me when the next thing is going to take place. Yeah. And I'm just like, okay, man, like that's fine. But where's the informational edge in this? Where is the differentiated view where you look at it and say, you know what? This is something that no one gets right now. And this is something that's not priced in. And I can actually prove it. And I actually love to, this kind of actually connects to how either of us think. But one of the things I shared at the beginning of this stream that I talked about was this tweet that I thought was really good because it connects to this idea of developing an informational edge. Eric Jorgensen, who just pulled together the Book of Elon, he says you can either monitor the ever-changing situation or learn timeless principles that will serve you the rest of your life. Choose wisely. And I do think that there is this entire idea of monitoring the situation. Monitor the situation. Monitor the situation. And that's okay, right? I think it's fun and you can kind of like tweet about it and meme about it. But if you are terminally online, if you are always just refreshing your screen, looking at the news, looking at this, looking at that, always saying like, what's moving, you are never going to set yourself in a place to know why things are moving and to be able to respond to that well, because all those things are moving because people understand these larger distributions of each player. right? And so I think that if you expect to just be in the doom loop of Twitter and all these other social media platforms and the market news, and then identify some exceptional opportunity just because you're monitoring the situation, you're just not going to have any really original thoughts. It's at best going to be imitation. And it goes back to that idea of, I think we talked about it yesterday. Ralph Waldo Emerson has a great section in his book on self-reliance that just says imitation is suicide because of how dangerous it is. And I think that's just, you posted a clip of Kobe recently that you can kind of talk on that I think is really interesting on that idea as well.
Yeah, it was Thread Guy did an interview with him yesterday. You don't really get to hear from Kobe much, and he's kind of a legend in the crypto streets. But Thread Guy asked him, what is the trait across all of the outlying performers in crypto? Like, what's the commonality? And Kobe's answer was basically like, they're all self-directed. They don't live on the timeline. They believe in their own work and their own decisions, and it often seems a bit crazy. And those are the guys that end up having these kind of legendary runs. I mean, there's so many things that like sound like this, right? Like when I read that Eric Jorgensen thing, I'm like, it sounds like you could give water to a horse or you could teach it to drink or whatever. Or like, what was the thing? Or you could lead a horse to water, but you can't teach it to drink. Or what was the one that was like, are you trying to be somebody? Or what was the other part of that?
Are you trying to do something or become somebody? Or
right.
build something or become somebody?
Yeah, to me, it all is like the same idea, right? And if you're gonna, or like the whole marketing funneling or whatever, or you gonna build the startup that, becomes like, if you want to be in the monitoring the situation or the funneling game or the clickbait or like the whatever, you have to be the best at that. And that's like a race to zero and good luck. And it's not going to be original, right? It's like YouTube. That's why my YouTube thumbnails are like not that great. And I love it. I like don't want the Mr. Beast style YouTube thumbnail. You know what I mean? Like it's all just this, like it all mushes together. To me, it's just not original anymore. Podcasts have become the same thing. So yeah, it all just like, it all kind of aligns. The same theories. You would probably say the same. Is like, that's why you read a lot of old books, right? It's because like the best ideas have like survived the test of time.
100%. I think it's the what we call the Lindy effect of, if something has been around for a decade, it has a higher probability of being around for another decade than something that's only been around for a year, which is difficult for people to understand because, the thing that just came out seems novel. It's going to change the game. It's going to do everything, right? And it goes back to this spectrum of things where what is the game that we're playing? How is it shifting? Do we have regimes that kind of shift with it? And how does that work exactly? And I think that here's actually a great question.
I was just going to ask you to bring that up. I was like, this is exactly the point here.
Yeah, I think it's good. I think it's, well, but by the way, guys, if you're watching this, throw questions in the chat. I mean, this is literally the time if you want to chat about something where we'll go through the chat, and if you ask a question, we'll cover it. But I think I would say in two elements here. One, this goes back to this chart that I shared about how do you quantify the different moving parts and their cadence and their weighting and the pace of the game, which I share these with paid subscribers on the Substack, and how that works. And I've been talking about here. Oh yeah, I think equities are going to keep moving higher because of because of how these things were shifting. So you can see in green right here, geopolitical risk. It was actually previously down at these bottom levels around 30% plus, and then it dropped to 9%. So the fact that it dropped to 9% and equities rallied is in itself an indication that we're being less sensitive to geopolitical risk. And so I think that in itself is a signal of how to quantify these kind of things. And I think that the entire point is that especially on an institutional basis, I'm not gonna, I don't really comment on other people's views on things just because I don't find them, I only really chat with people offline and get color offline and share my views with some of this stuff offline, or have constructive conversations with people offline, just because the entire thread and online stuff is just set up for debates and attention seeking and not really constructive ideas. And you'll notice that a lot of people will avoid debates and podcasts simply because you can grow a following these days by just posting a bunch of crap, and you're never testing your views. You're never having a falsifiable thesis, which goes back to this idea that I laid out in this tweet. In order to have correct iteration, so that means in order to develop properly and update your view, you need to have a falsifiable view with scenario analysis and redundancy planning. So that means your only ability to succeed in market is based on iteration and adaptation, the fact that you can get better. So it's not just about changing, it's about iterating. I think that's the key thing. Is they actually gave a great example. I think this is the example they gave or David Deutsch gave in his book, where he said, just changing is not going to help you improve. Because they talked about this example of back in the day, you could have the weather kind of change, and people would say, oh, well, we need to sacrifice animals to the gods so that the weather changes. And then the weather doesn't change, and they say, oh, instead of sacrificing sheep, we need to sacrifice goats. And they're like, look, we're adapting. We're trying new things. We're changing. And it's like, yeah, but you're changing in a way that's uninformed. You're not creating a falsifiable view to say, like, does this have a connection to the weather? Does this change in this way? And so iteration is all about informed adaptation, not just change for the sake of change. And then to have that, you need to have a view that is testable, to say, okay, well, I know that I can quantify this connection here, so let me just focus on that. And I think that's really where you come up with those ideas, where how do you know if something's priced and unpriced? It goes back to how are we quantifying those moving parts. James, anything to add to that?
Yeah, I think that's great. And also, like, the reason I like this question is because I think the framing of the question is the monitoring the situation frame. Like,
Right.
You're already racing against somebody because you think that, like, it's framed in a sense of like, I want to be first to this thing. But if you've been paying attention to what Flows is saying, it's like, if you understand at a foundational level where we are, and then you come across an outlier, you're not going to have to worry about it being priced in, because nobody is going to really know that exists. So if you're just worried about, like, how can we catch that thing before it's getting priced in, that's probably things that everybody's paying attention to, which is just, that it comes down to, like, who's the fastest, who's got the most resources, who can execute fastest. And you're just never going to win that race if you're just, like, scrolling and monitoring the situation. So you either have to pick that one and figure out how to get to those opportunities before they get priced in, or you have to drop that concept completely and you have to go the other way from the root, the foundation, to find the outlier that nobody is thinking about, that nobody's positioned for. Then it's like, you don't have to worry about the pricing it, right? Like it's just, nobody in, like, TradFi was even considering what that even was, right? So you're not entering the position there as in, like, you're not asking yourself, is this priced in? Is this? No, that's not even part of the conversation. So I just think it's an interesting, the way the question is framed, to think about how you're approaching your investing.
Yeah, I think go back to the fundamental principle of, how do I know something that other people don't know? And it's this idea of a secret. And I think this is the world operates around secrets that can't be reverse engineered. That's why I love, like, the ideas of Peter Thiel and Alex Karp, because their entire focus is, how do you have a secret that is impossible to reverse engineer and no one can figure out. That's your edge. And so I always look at anything I know or any trade I have, and I just say, is this something, do I know something that everyone else doesn't know? Or are they, and you can say like, oh, well, it's on social media, so everyone should know it. And I would say, well, if they this just goes back to like, it's like, if, do you understand that you need to work out? Well, yeah, I understand I need to work out. Do you? Well, no. It's just like, okay, well, then you clearly don't get it, because you would do it if you did. So it's just this idea of, people will always show exactly what they think with how they move their money. It's just like you look at someone's budget and you're like, yeah, dude, I can tell if you're disciplined or not. I can tell exactly like, what you're doing by looking at like your credit card statement. We all get it. So I think that's one of the things as well, is understanding that connection as well. I think this is another good question on, you guys spoke about the Oracle trade. It seems great. And when are you planning to exit the trade? I found this the hardest part of my trading is the exit. Would love to hear your thoughts on how you both time the exit. I can cover some of the technical side, but James, why don't you start with thinking about the exit and what that would look like?
Just exit. Yeah, I mean, look, we're all human, right? We all generally have like some sort of price target in mind, probably. But I shifted more towards trying to, for something like this, like, which I consider, given that I'm so short term, Oracle is more like an investment to me. It's more like wow, I got to ride this thing. I have to see where this goes over a long period of time. And sure, there's like some strike prices and some all-time highs and stuff like that. But along the way, like, we have to keep our mind open as to like policy shifts, regime changes, interest rate policy, and how that's going to reverberate out the curve to this sharp bet. So it's hard to have a price target on it. And that might require us to completely exit the trade because there was a massive fundamental pivot that could really affect this, right? So it's constantly iterating and adjusting expectations and time horizons to me. And if I ever see, I'm also a scalper, right? So it's like, if I see a really big fast run in Oracle and it gets 3/4 of the way to my strike price in 3 months, I'll probably remove some of that trade, because I would expect a period of a month or two where the trade's going to take a breather, and I want to capture some of that. Now, that's my style, right? That's me not wanting to give as much money back. That's me not wanting to swing as much within the thing. I've already accomplished some part of my goals. Like, that's going to be different from how Global Flows manages his trade. That's all okay. But I incorporate a lot of like the vibes and how I feel like the movement of the trade and the speed of the trade. And then I also have the side mention of, the more fundamental aspect, the sector flows, the positioning, the vol expansion, contraction, things like that. So I try to bring all of that together to be like, do I want to get in or out of this trade? That's how I think about it.
Yeah, I think that's good. I think when I go through this idea, this is all laid out on the Substack. Go to April 14th, 2026. You can see all the biggest bets I'm taking in the credit cycle. The Oracle one, I laid out the AI reflexivity loop. So that's the context. And then within that, you have the playbook for Oracle. So I've laid out everything for Oracle. So you should go on the Substack and go through this yourself. But I shared the risk reward for Oracle right here. So, we're in this, I shared it at 156. And then, I think we're going to make an all-time high, because I think of the discrepancy in pricing right now. So that's my view. If the evidence changed in the interim, then I would change my view. And here's the thing, like, this is why it's important to have a clear analysis of the situation in real time, because you could have, we could bid up to 260 and my view begin to change because the evidence is not stacking up for the original view that I had. And imagine this, the original view I could have could change, or it could be wrong. And so I'm going to change my position and maybe I'll still make money. And so I think that's one of the important things is understanding why it's taking place and how it's functioning. And this goes back to the model that I shared of how much is market versus fundamentals versus sector flows. And, I'm long the 12, 17, 20, 27, 310 call. So, clearly I think it's going to go to 310. That's my view. But I've also sized these calls smaller against the core position because I know that there's a trade-off for buying calls versus a core position. And so you're always weighing these trade-offs and your exposure for how things are taking place in real time. And so, this goes back to go through all of these reports and models and be able to stay up to date on them as you kind of do that. So that here's the key thing. You can separate where your mistake is in an execution format and where you have an incorrect view. Because if you just get shaken out of an Oracle trade because you size too much, that has zero to do with the actual Oracle trade. It has to do with you oversizing. But then if you say like, oh, well, now I don't know about Oracle because I got shaken out of it, right? You're totally misdiagnosing the situation. So I think that's one of the key things to think about and always have a distinction in. The next question here, I think is a really good question. That is one of the things I want to cover is how do we know that this rally right here is not short covering? And actually, if you watched the video I did earlier this week, let me see if I can find it. Hang on.
It's an impressive move. Just an impressive move.
Totally.
Well done, America.
Let's see if I can figure this out. Here we go. There we go. All right. Where is this? I did a whole live stream on this. I'm trying to find it right now. Here it is. Let me pull this up right now. Yep, here we go. Okay, this is, if you go to again, this is why if you're on the live streams every day, you'll get all this. April 20th. I laid all of this out in the live stream on April 20th. If you scroll down to the slide deck on April 20th, this will answer the question for you. We're going to go to the slide deck that I just opened, which is saying, okay, how much of this move is short covering and just positioning unwinding versus a macro change? And then what you would need to say is, well, how much of the short covering is, or why is that short covering happening in the first place? And what we can see is that the Goldman Sachs High Yield Debt Sensitivity Index is rising right here, which means that, zoom this out. And again, you can go through all these slide decks are laid out for everyone every day on Capital Flows Research. So, we have the Goldman Sachs index making a new high, which in itself is an indication that we are seeing low quality companies bid. Now, to be clear, you are also having all the highest short interest stocks rally as well. Now, that can be from a positioning unwind and some short covering, but I mean, all of these stocks rallied the most during 2021. One of the periods of time when the most short squeezes happen is when macro liquidity gets pumped into the system. So this idea of, oh, well, it's just short covering. I mean, by the way, in ES, like you can have short squeezes, but you're still seeing capital move out the risk curve and buy all these other names that I laid out in this slide deck. And let me see if, here's the Goldman Sachs most shorted index, which is rallying. So, there's clearly a positioning unwind taking place. And then you're having some call skew move up in ES. The key thing to recognize is that, yes, there was some panic buying to reprice right here as call skew blew out. But you'll notice that it also took place across the dollar, and you had some curve changes and things like that. And that's why, and again, you're also having some of that happen against Bitcoin. That's why, yes, is a position unwind? 100%. But you have to know, why did that position unwind happen in the first place? Because everyone shorted the market on geopolitical risk when liquidity was actually increasing in the market, which if you were, again, going through everything that I laid out on the Substack for paid subscribers and on all the live streams during that time, here is 2-year real interest rates and even 1-year real interest rates. Again, 1-year real interest rates have made new lows, right? And so when you see real interest rates making new lows on a macro basis, that's being reflected in FX and the interest rate complex and the curves, that is allowing money to go into the market, which is why the dollar has fallen a bit. And so the entire framework I laid out is that the Fed has set up a situation where their inaction is pushing money into markets, which is reflected in what? Real interest rates, FX trades, and capital moving out the risk curve, which are all the things that we are seeing. And is that causing a short squeeze? Yes. But the fact that it's causing a short squeeze is a second and third order effect of the unwind in the first place. Because think about this, is if it was just a short squeeze, then what would you see? You would only see the stocks that have short position in them getting squeezed. You wouldn't see everything else rallying, which comes back to this idea of, well, what sectors are actually rallying right now? It's things like tech. I mean, go through history. This is not, short covering. All of this is short covering. It's not anything else. I mean, you think let's see, what percentage? A 17% move in the NASDAQ is short covering? It doesn't happen, right? It just doesn't happen. It's too large of a move because who are the shorts in market, especially for the mega caps? If you look at mega cap short interest, it is collapsed so much over the years because everyone knows you don't short the index because all of the passive flows that are coming in. Though that's actually why where people short the Russell, there is more short interest in the Russell because you have those stocks that have a higher sensitivity to the economy. But this goes back to this entire slide deck that I shared. I was laying out that you should probably actually be betting on all of the stocks in the Russell having short squeezes. And so this entire slide deck, I laid out all of the names that you would want to bet on in the Russell for short squeezes. And that's the entire thing I laid out right here, that you want a bet on short squeezes. Think about it like this. The fact that you have a short squeeze doesn't necessarily mean that you are going to have it just like squeeze and then it's going to map back down and dump back down. You have to actually ask in the first place, well, why are shorts getting squeezed? And so again, people use this kind of like cop out of like, oh, well, it's just shorts getting squeezed and then we're going to roll over into the bear market. Okay, well, where's the driver of that bear market? And people are going to say, well, liquidity is doing this, and that. And again, it goes back to the liquidity argument of, okay, well, where is this negative liquidity coming from? Because when you look at rates, FX, and the risk curve, they're all saying that macro liquidity is expanding. And so I think that's one of the critical things to really understand in this period of time. And that's why it connects to this, larger framework about, where we are in the cycle. So, James, anything to add to that, or anything you think I should expand on?
Nope.
All right, let's go through some more of these questions, and then I wanted to go through a couple other ideas before we hop off the stream. How do you differentiate between credit risk? Oh, actually, there was a question up here I wanted to cover. How do you model geopolitical risk? Just think about the things that cause geopolitical risk in markets and map the attribution for them. So, for example, crude is probably part of geopolitical risk, but you need to understand when it's geopolitical risk and when it's just a demand side versus a supply side versus, other factors. But it's going to connect with the energy market, and it's going to connect to some other factors in why the energy market is pricing a certain thing. So I think that's kind of a good thing as well. All right. How do you differentiate between credit risk and duration risk? Again, I did an entire thing on this. let's see. If you go through the live streams and you go to the playbook for the credit cycle melt up, April 13th through 15th, read these April 13th through 15th and watch the live streams. That covers all of it. And I gave you all the models for it. So you can go through all of that. Here's the one thing I would say about volume. A lot of people talk about volume. Oh, the market moved on low volume instead of high volume, so it's not a real move. I do not really believe in the same type of volume profile stuff that everyone uses. Just doesn't really show me the type of signal that I want or that I think is helpful. And so overall, what volume profile usually shows is just price, because if you see volume profile, it usually just overlaps with how much price you have in your look back as opposed to the actual volume profile. And volume profile overall, at best, probably only helps you on an intraday basis. And that's only because there's lower volume in the overnight session and there's a volume pattern in the cash equity session. But that's more about the time, not if there's high or low volume during that time. And then everyone kind of manages their hedges around catalysts and stuff like that. So overall, I look at volume, but I think it has a lot less of a signal than people kind of give it credit for. I'd be curious, James, how you think about that from a order book perspective or some other kind of ideas about, is this high volume or low volume and a view?
Yeah, I read a book that's super popular, like volume profile book a long time ago, but ultimately it was just another like tool in my toolkit. I think it's fine. Like, I don't rely on it or look for it. You have all these people that are like, especially these days with meme stocks and volume from options flow and stuff. They're like, look, unbelievable options flow developing at these prices. And then 2 weeks later, nobody mentions it. So I don't know. I feel like it could be false flag. I feel like it can matter. Gotta just kind of be situationally dependent, I suppose. But I don't.
Not the end all be all.
No, not. And if you think anything is, then I think you're on the back foot.
Yeah. All right, James. I'm sorry, but we're pulling up this. Well said. People know to eat more broccoli and less pizza. But do they? Nope.
Yeah. I'm on the people's team here.
Take
your broccoli and kick rocks, bro.
It's every time James and I get together, I think we always have pizza. We always have steak, but I feel like we always have pizza almost pretty consistently, right?
You know what we don't have?
What?
Broccoli.
That's
never.
So true. I don't really eat greens.
Nor would I. Imagine thinking society was built off sharing a meal with vegetables.
All right. Another question here. My take. Correct me. Have a lens on the macro situation. Look at the raw data. Connect it to rates and FX. Understand the driver. Connect it to other asset classes. Understand the correlations. Understand the charts. Have a lens on political, geopolitical situation. Filter the noise. Know what's driving the charts on your time frame, connected to everything above. Yep. If you just do all that, and then he says identify equilibrium or disequilibrium within the market, look for asymmetry only, throw everything else away, build a thesis scenario plan for everything, build your own system. Hey, if you do all that, you will be fine. This is so simple, guys. Just do this. Whoever this guy is, I want to follow this guy. You should tag me in Twitter, so I'll follow
just you. Like AI summarize. Yeah, AI summarized your life basically. Made it sound like he whittled you down to a comment. Basically.
He did. I mean, honestly, guys, these 4 comments right here is literally like my life.
Yeah.
This puts me in a box. This encapsulates me, and this is just all that I'm good for. So, all right. What happens to the market if the war in Iran escalates? I don't know. It probably goes down a little bit and then just bids again because it's decreasing its sensitivity to all of that stuff. I just think I don't really understand, because people need to understand the positioning side. So it's all about how are we mapping the positioning of stocks and rates and everything else to the conflict in Iran. So I think that's one of the key things. This will go to, on this dashboard that I share everything on. This will go back to on the US side. We are really waiting for where we're going to be in the, the Z6 contract. We're basically chopping around. And this is one of the things I said, stocks are going to outperform bonds. And that's exactly what we're seeing. And when we have stocks outperform bonds, you want to watch the Z6 contract right now and how we're going to price. Because notice we priced 25 bips of hikes this year, and then we came back down. We're chopping in a range here. We're not really moving. Now notice in the Z7 contract, we are pricing 25 bips of cuts. So that means that between now and, let's see if I can find it. Boom. Nope, doesn't do it. I thought it did. In the Z6 contract, between the Z6 and Z7 contract, where pricing, that spread is going to be really important to watch. Let me see if I can pull it up, and I'll explain it to everyone. So we're pricing, roughly a pause this year. And then right here in the Z6, Z7 contract, the way you want to think about this is how many cuts are we pricing between you have two stages of this market right now, two stages. Number one is how many cuts are we pricing in Z6 for this year? So if you can know that number, which is, again, pretty straightforward, if you just go to the Z6 contract and say, okay, well, how many cuts are we pricing to the end of this year? Basically 0. We're at settlement, which means we're pricing 0 cuts. Then from there, we want to say, okay, as a function of that, that's stage 1. So we're pricing in Z6, 0 cuts. Okay, now we're going to say, okay, if they cut too much this year, they could cause inflation to move up. If they hike this year, they can cause inflation to move down. If they pause, then maybe you'll have it neutral, or maybe it depends on how it transmits into core CPI. This outcome right here is going to drive the Z7 contract. And that's what this spread right here is. So basically in 2027, how many cuts is the market pricing? So basically the market moved all the cuts it was pricing from this year into the spread of next year. And now we're moving back up to price more cuts in 2027. So the market is basically saying we're probably not going to get more cuts this year than 25, but we're beginning to tick up and saying, yeah, but we might get cuts in 2027. We're pricing 20 bips, and then if we keep grinding up, we could, price. If we keep grinding up, that'll price less cuts this year. I was reading the spread wrong. If we're right here, we kind of move down to price more cuts, and we're in this range, which means that if we have, let me pull these off. If we move down in this spread, we'll price more cuts in 2027. If we move up, we'll price less cuts in 2027. And I think that's going to determine how exactly, I'm not sharing the right screen, am I? Ugh. It's just drawing all this stuff for nothing.
Yeah, I thought you were referring to the bottom right thing. I was trying to kind of understand. But
sorry, let me go through this chart again, guys. I'm a little. Let me not say that on stream. All right. When we move down, we're pricing more cuts in 2027. So there's two stages, like I said. The Z6, which is pricing 0, and then how does that impact Z7, which is the amount of rate cuts we're going to get next year. And so when we move down, we're pricing more cuts in 2027 relative to 2026. So this is all about kind of a pair trade between, if you kind of come into the market and say, I don't know how many cuts we're going to get this year or next year, but I think we'll have more next year than this year. So I don't know what the number is. I just think it's going to be more next year than this year. And that's why this spread moves down to bet that and to reflect that. So here was kind of the extreme. We are pushing all the cuts into 2027. And now we're kind of coming back up to say, okay, well, now if this keeps moving up, we'll price out all the cuts in this year. So if we move back up to this level, the market would price 0 cuts for 2027. So this is the period of time that we're in. We're pricing a pause, but even though we're pricing a pause, you will notice that inflation and 1-year inflation swaps are still sitting at their highs right now. And so that means that, the market today is indicating that inflation risk is still high. And you can see that across, 10-year, 30-year. My view is that you're probably going to have long end interest rates move up just a little bit. I'm neutral bonds right now. I just don't want to be long bonds. But on the short end, you're having inflation expectations still remain elevated. They're not coming back down enough. And so that means that any pauses or cuts by the Fed into this on net is pushing real rates down, which is why we are seeing 1-year and 2 real interest rates move down. That's one of the reasons why equities are up. And my view is that you're going to have, we're even seeing 10-year real rates down right now, as nominals are not moving in lockstep with inflation swaps. So the idea is that we're in 1-year real rates, we're 45 bips from 0. I just think that's the most significant chart in macro right now, because if we get to this bound right here, where you have Warsh, let's say Warsh pulls back the balance sheet and contracts the balance sheet and then cuts rates. Again, I know that he needs all the votes and all that other stuff, blah, blah, blah. Let's say we get more cuts and we contract the balance sheet. That could take real interest rates and bring them negative. And then it'll be about, well, how much of that is supporting the economy versus, contracting liquidity in financial markets. And that will be, one of the major things that drives everything for markets over the next 3 months. So that
was just 75 basis points yesterday, I think, on stream.
It was actually, I was sharing, there's 1-year and 2-year rates, real rates. I think on the 1-year side, if we zoom in, those were 51 bips. I think it was 2 years that was 95 bips. Maybe it's 5 years or something like that. But yeah. Okay.
I might be remembering the number wrong, but not far away from going negative is the point.
No, and I mean, again, when equities are right here and, pushing these highs, I think that's pretty significant. And one of the things that we actually recently
I got to run though, so I'm gonna let you go. Thanks for tuning in, guys. I'll catch you guys on the next one.
Cool. I'll catch you later. I'm just gonna cover one more thing for everyone as James hops off. I want to cover, I would encourage everyone to go to their website. They update everything here and explain where they're at with everything. So if you want to go through the model on where PER is, how many shares they have, what they're buying or selling, you can go here and you can see the breakdown of everything that they're doing. My view is that PER is going to continue to move up and to the right. I'm still holding all the shares that I have. I think Hype is going to move up and to the right as well. And Oracle, I'm still bullish Oracle. Oracle and PER are my 2 biggest bets. Obviously, they're on sides, and so I'm just holding the risks that I have. I think that gold and silver are going to move up as well. Crude just seems like it wants to roll over to the downside again. I'm just waiting because I think there's going to be a moment where the euro makes a bottom and then begins to tick up. And that's really what's going to take ES and make it move a lot higher. And, right now we're still seeing pretty significant resilience in these, areas. And as the VIX is at these levels. So as long as the VIX remains below these levels and holds there, as you have capital move out the risk curve, that's going to be a really key thing to watch. So final question. I think this is a great question. If the Fed is adding short end liquidity, is that a real regime shift or a temporary support? And how does war-driven inflation affect how the long end can last? Great question. So the Fed helping their inaction to add short end liquidity Is that temporary or is it going to persist? Well, here's the thing. What we know, and what I would say is both of your questions are really key because they connect to each other. If the Fed is adding short end liquidity, how well is that going to be supported? It will all depend on how much headline inflation feeds into core. And if a lot feeds in, that will push up that will push up long end rates. And that could begin to put a cap on this rally. I don't think that's going to happen for another month or two. And I don't think if that did happen, the Fed is not going to respond right away. They're just going to keep this wait and see approach, which inaction into this type of inflationary impulse is always going to be a net liquidity impulse as long as the Fed is not acting. Could that move around long end real rates? Yes. So you need to be careful of that. If we have, for example, you have, ZB and UB and ZN moving down and beginning to break these levels, right? And they don't hold there. And that starts to drag on equities. I would be very careful, but I don't think that equities are going to move below this level right here. So if long end rates begin to move up significantly, can that impact equities? Yes, but I believe only within a certain range, which is why, I've been talking about being long equities since down here, especially the Russell. So now if you have that, you're probably on sides, hopefully. And I think that we're going to remain above this level. If we have long end rates blow out, could we pull back to here? Yes, I think that's possible. But then I think we just send it up again because of the credit issuance that we're seeing and all these other changes that we're seeing. So, and again, capital is moving out the risk curve right now. It's bidding all these high risk names. So I'm not really interested in getting short the index right now. And I think that the data really supports that. So those are all my views for the live stream for today. If you want all of the breakdowns that I'm going to send out, I'll send out any of the charts that I shared today. You can get them at capitalflowsresearch.com. Again, I would really encourage you, go through all of the research on Capital Flows Research, on the macro reports, interest rate reports, equities, on all the different changes that are taking place. All the educational primers are laid out on the Substack. If you guys have any questions, you can always shoot me a DM on Twitter. And I'd always really appreciate it if you guys are able to share all the work that I'm doing. It really helps. And we will continue doing these streams every single day at 8:30 a.m. Mountain Standard Time. I will catch you guys tomorrow.